What if I told you the money in your bank account has a chronic illness? It's a condition that some historians see as part of a predictable cycle, one that empires and their currencies have gone through for centuries. The Dutch guilder had it, the British pound had it, and as of 2025, the US dollar is showing all the symptoms. Most people don't see the pattern, but history leaves clues. It provides a kind of map that charts the life cycle of great powers and their money. For centuries, this cycle has repeated with an almost eerie consistency, and yet every generation seems to believe this time is different. They believe their money is special, that their country is immune to the forces that brought all the others down. They're always wrong. Stay with me and I'll show you the specific warning signs from past empires that signal we're entering a new, difficult chapter. More importantly, I'll explain what this inflation phase actually means for your savings, your retirement, and your family's future. This isn't about scaring you. It's about understanding the historical moment we're living in and using that knowledge to prepare. Before we dig into the stories of fallen empires, you need to understand the blueprint itself. This isn't just a random series of unfortunate events. It's a 7-phase cycle that, according to some historians, every global reserve currency has followed. Think of it as the natural life cycle of economic power. Phase 1 is dominance. This is the golden age. A nation comes out of a major war or a period of huge innovation as the undisputed economic and military superpower. For the United States, that moment was cemented in 1944 at Bretton Woods. With Europe in shambles and America holding most of the world's gold, the dollar was crowned the world's reserve currency. Every other currency was pegged to it, and the dollar itself was convertible to gold. This gives the top nation an incredible power, often called an exorbitant privilege, the ability to buy things from the rest of the world in a currency it can just print. Overextension means confidence from phase 1 leads to big ambitions. The dominant power becomes the world's policeman, innovator, and banker. It builds military bases across the globe, funds massive social programs at home, and extends its influence everywhere. For a while, the powerhouse economy can handle the expense, but slowly, the costs start to outweigh the benefits. The empire's reach starts to exceed its grasp. This always leads to phase 3, structural deficit spending. This is a critical turning point. It's when spending more than you earn stops being a temporary fix for an emergency, like a war. It becomes a permanent part of the government's budget. The promises made during the overextension era, the military spending, the social safety nets, are now politically impossible to cut, but the economy isn't growing fast enough to pay for them. The gap between tax revenues and government spending becomes a canyon. Year after year, the nation has to borrow more and more just to keep things running. So how does a government pay for these massive deficits when the world gets a little nervous about lending it more money? It turns to money printing. This phase often gets hidden behind fancy terms like quantitative easing, but the idea is simple. The nation's central bank creates money out of thin air to buy the government's debt. It's the modern version of a king shaving the edges off his gold coins to mint new ones. In the short term, it feels like magic. It covers up the deficit without the political pain of raising taxes or cutting spending. But it's a dangerous game. Every new dollar created dilutes the value of all the dollars already out there. This brings us to where we are now. Phase 5, the inflation phase. This is the consequence. After years of money printing in phase 4, the debasement of the currency becomes obvious. It shows up as a steady rise in the cost of everything, from groceries to gas, from houses to healthcare. Politicians might blame it on supply chains or world events, but the root cause is the massive expansion of the money supply. Inflation is no longer a temporary problem, it's a feature of the system. It's the moment when average people start to feel that their money just doesn't go as far as it used to. It's the beginning of a psychological shift, a loss of faith in the money as a stable way to hold value. What comes next are the final two stages. Phase 6 is the loss of confidence. The inflation that started at home begins to spill out onto the world stage. Other countries, watching the value of their dollar reserves shrink, start looking for alternatives. They trade with each other in their own currencies, they buy hard assets like gold, and they quietly buy less of the reserve currency's debt. This is the most dangerous phase because it can feed on itself. The less the world wants the currency, the weaker it gets, and the weaker it gets, the less the world wants it. Finally, there's phase 7, replacement and collapse. The currency loses its world reserve status. It's replaced by a new currency, or maybe a mix of currencies or assets. For the nation that printed that money, this is a catastrophe. The exorbitant privilege is gone. The country can no longer print money to pay its bills, leading to a potential currency crisis and a devastating drop in the standard of living. This 7-stage process is the key. It's the historical map that lets us see not just where we are, but where we're likely going. To really see its power, we have to look at the empires that walked this road before us. To get a sense of the dollar's future, we have to go back to the 17th century, to the Dutch Republic. For almost a century, from around 1640 to 1720, the Dutch guilder was the king of global finance. It was the dollar of its day. The story of its rise and fall is the first great cautionary tale of modern finance. The Dutch Golden Age started with a revolution in trade. The Netherlands, a tiny nation of merchants and sailors, built a global empire not on land, but on controlling the seas. Their secret weapon was the Dutch East India Company, the VOC, the world's first multinational corporation. The VOC dominated the incredibly profitable spice trade, with outposts from South Africa to Indonesia. Amsterdam became the center of the world. It had the world's first central bank, the Bank of Amsterdam, founded in 1609. This bank was a modern marvel. It provided a stable and trusted currency, the bank guilder. You could deposit a messy pile of foreign coins and get a credit in standardized, reliable guilders. This trust made Amsterdam the hub for global payments, and the guilder the world's top reserve currency. This was the peak of Phase 1, dominance. But empires are expensive. The Dutch were constantly fighting off bigger rivals, mainly England and France. This led to a series of incredibly costly wars. Suddenly, this nation of traders had to become a nation of soldiers. They built a massive navy and kept a large army to protect their interests. This was the classic start of Phase 2, overextension. The empire's commitments started to strain the small nation's resources to the breaking point. How did they pay for it all? You can probably guess. This is where Phase 3, deficit spending, began. The Dutch government started borrowing on a scale never seen before. At first, with a strong economy and a trusted central bank, borrowing was easy and cheap. But wars are a hungry beast. Debts kept piling up, especially during the War of the Spanish Succession in the early 1700s. Tax revenues couldn't keep up, so the Dutch government turned to that same fatal trick that all empires eventually use. They started debasing their currency. Phase 4 had arrived. While the prestigious guilder at the Bank of Amsterdam stayed stable for a while, the everyday coins people used started to decline in quality. The government started putting less silver in their coins to create more of them. It was a sneaky form of money printing. The Bank of Amsterdam tried to hold the line, but the pressure was too much. Eventually, even the mighty bank was forced to secretly lend huge sums to the government and to the VOC. destroying its own reserves and its reputation. The world started to notice. This was the shift to Phase 5, the inflation phase. As the quality of Dutch money fell, prices rose. More importantly, the trust that was the bedrock of Dutch power began to crumble. Merchants became wary of accepting Dutch coins. Foreign investors, once eager to buy Dutch bonds, started looking for safer places to put their capital. And where did that capital go? To the Netherlands' biggest rival, Great Britain. As Dutch power faded, British power was on the rise. London was copying Amsterdam's financial model. The Bank of England was founded in 1994, and Britain adopted the gold standard, offering a stability the Dutch guilder no longer could. Over the 18th century, money and talent steadily flowed from Amsterdam to London. It wasn't a sudden crash, but a slow, grinding transfer of power.
This was Phase 6, the loss of confidence. Global trade slowly shifted from being priced in guilders to pound sterling. By the time revolutionary France invaded the Netherlands in 1795, the Bank of Amsterdam's insolvency was public, and it collapsed. Phase 7 was complete. The guilder's reign was over, and the era of the British pound had begun. The story of the British pound sterling is probably the closest and most painful parallel to the US dollar. For over 200 years, the pound wasn't just money, it was a symbol of global order. Sound as a pound was a phrase the whole world understood. Its journey through the 7 phases is an epic tale of triumph and tragedy. The pound's Phase 1, its era of dominance, was built on the Industrial Revolution and the gold standard. Britain was the workshop of the world. At the same time, the Bank of England tied the pound to a fixed weight of gold. Anyone could walk into the bank and trade their paper pounds for real gold. This created incredible trust. London became the center of global finance. But this dominance planted the seeds of its own downfall. For Britain, Phase 2, overextension, was the crushing cost of maintaining its sprawling empire. From the Boer War to the Boxer Rebellion, the British military was constantly fighting to protect its colonial interests. The Royal Navy, the most powerful in the world, was a staggering expense. For decades, Britain's industrial power was so great it could afford this imperial burden. The turning point was World War I. The war was an economic disaster for Britain. The nation sold off a huge chunk of its foreign investments and went from being the world's biggest lender to a major debtor, owing massive sums to the United States. To pay for the war, Britain had to abandon the gold standard. This was the definitive start of Phase 3, deficit spending, and Phase 4, money printing, on a scale nobody had ever seen. After the war, Britain was a shadow of its former self. Heavily in debt, its industrial base was now being challenged by a rising America. In a desperate attempt to reclaim its glory, Britain made a fatal mistake in 1925. It put the pound back on the gold standard at its old pre-war value. This made the pound massively overvalued, crippling British exports and leading to economic stagnation. And then came the 1-2 punch that would change everything: the Great Depression and World War II. In 1931, Britain was forced off the gold standard for good. The pound's anchor to reality was cut forever. World War II finished with the First War started. Britain was forced to sell off the last of its foreign assets and borrow on a colossal scale from the US. By the end of the war, in 1945, the situation was clear. The United States had 2/3 of the world's gold and an industrial base larger than the rest of the world combined. Britain was bankrupt. This is when the official transfer of power happened. On July 4, 1944, delegates from 44 nations met at Bretton Woods, New Hampshire, to design a new financial system. The outcome was obvious. The new system would be centered on the US dollar. All other currencies would be pegged to the dollar, and the dollar alone would be convertible to gold at $35 an ounce. This was the public start of the pound's Phase 6, the loss of confidence, and its final slide into Phase 7, replacement. For the average British citizen, the consequences were devastating. Their savings were wiped out by inflation and repeated devaluations. The once mighty empire had to enforce rationing for years after the war. The standard of living collapsed relative to the booming prosperity in America. The British went from being masters of the world to the sick man of Europe. And that brings us to today. The year is 2025, and you can almost see the echoes of the past. The United States stands in a place hauntingly similar to where the Dutch stood in the early 17th century and the British in the 1920s. It has fully entered Phase 5, the inflation phase. Let's trace the dollar's journey on our map. Phase 1, dominance, was the post-World War II era, from 1945 until 1971. The Bretton Woods system made the dollar supreme. Phase 2, overextension, kicked off in the 1960s with the hugely expensive Vietnam War and the ambitious Great Society social programs at home. This led directly to a crisis. Foreign nations, seeing the dollar print dollars to pay for it, got nervous and started trading their dollars for American gold. The U.S. gold supply dwindled. This forced President Nixon's hand, and on August 15, 1971, he temporarily suspended the dollar's convertibility to gold. That temporary measure is now over 50 years old. That single act marked the definitive entry into a world where the U.S. could engage in Phase 3, structural deficits, and Phase 4, money printing, without any real limit. And for the next 5 decades, that's exactly what happened. Every crisis was met with more debt and more money printing. The 2008 financial crisis, and most dramatically, the 2020 global pandemic, which unleashed the largest monetary stimulus in human history. The result was predictable: the great inflation spike of 2021 and 2022. Now, in late 2025, the headlines might say the crisis is over. Officials will point to inflation rates that have cooled from their peaks to a more manageable level of around 3%. They'll declare victory. Don't be fooled. This is the true danger of Phase 5. It isn't always about hyperinflation. It's about the normalization of inflation. The acute fever of 2022 has passed, but it has left the dollar chronically ill. The cumulative inflation from 2022 to 2025 has already erased about 10 to 11% of your money's value. That's a permanent loss of your purchasing power. More importantly, the underlying disease, the structural deficits, is worse than ever. The U.S. national debt has surged past $35 trillion and is still climbing. The cost to service this mountain of debt has become a terrifying line item in the federal budget. Interest payments on the debt for fiscal year 2025 are projected to be around $870 billion and are expected to cross $1 trillion annually around 2027. That's more than the entire defense budget. It's money that builds nothing and funds no services. It is simply the cost of past promises. This is the trap of Phase 5. The debt is now so large that the Federal Reserve is caught. If they raise interest rates high enough to truly kill inflation, they risk bankrupting the U.S. government. If they keep rates low to help the government borrow, they risk letting inflation flare up again. Their choice seems clear. A slow, grinding inflation is the only politically easy way out. It allows the government to pay back its enormous debts with dollars that are worth much less than the ones that they borrowed. It's a hidden tax on every single person holding dollars. So when you hear that inflation is stabilizing around 2.5% or 3%, understand what that means. It means the system has accepted a permanent, ongoing debasement of your money. This is Phase 5. It's the phase where your savings are slowly sacrificed to keep the system afloat. Phase 5 is a slow burn. Phase 6, the loss of confidence, is when the fire starts to spread. This is the phase where the rest of the world, after watching the currency debasement of Phase 5, begins to actively get out of the way. This isn't some distant future. The warning signs of Phase 6 are flashing right now in late 2025. For those who know what to look for, they are clear as day. Warning sign number 1, the quiet retreat from U.S. debt. For decades, U.S. Treasury bonds were the safest asset in the world. Foreign nations held trillions of them. But that's changing. While the dollar amount of foreign-held debt is still massive, their share of the market has been in a clear, long-term decline, dropping from a peak of nearly 35% in the early 2010s to around 30% today. Nations aren't dumping their bonds, but they're not buying new debt at the same incredible pace the U.S. is issuing it. They're slowly backing away. Warning sign number 2, the global gold rush. So what are they buying instead? Physical gold. Central banks around the world have been buying gold at a pace not seen in over 50 years. The years 2022, 2023, and 2024 all saw massive purchases, each exceeding 1,000 tons. Nations like China, Poland, India, and Turkey are leading the charge. This is the most primal signal of a loss of faith in paper money. Central bankers, the most conservative players on the field, are trading their digital dollars for the one asset that can't be printed into oblivion. They are telling you, with their actions, that they don't fully trust the future value of the dollar.
Warning sign number 3, the rise of non-dollar trade. Another key sign is the growing number of large trade deals settled outside the dollar system. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new partners, are leading this push. We're seeing major commodity deals from oil to iron ore being priced and settled in currencies like the Chinese yuan. Saudi Arabia is now exploring pricing some of its oil sales to China in yuan, a direct challenge to the petrodollar system that has been a pillar of dollar dominance for 50 years. Each deal seems small on its own, but together they represent the construction of a parallel financial system. Warning sign number 4, the slow decline in global reserves. The most watched number is the dollar's share of global foreign exchange reserves. At its peak around the year 2000, the dollar made up over 72% of all central bank reserves. As of late 2025, that number has fallen to around 58–59%. Now, this is not a collapse. The dollar is still the dominant reserve currency by a wide margin, but the trajectory is unmistakable. It's a slow, downward grind. This is exactly what the historical model predicts for Phase 6. There is no single D-Day for the dollar, but rather a gradual erosion. The key psychological line to watch will be when the dollar share dips below 50%. We're not there yet, but we're heading in that direction. These 4 signs are the rational responses of a world adjusting to the new reality. They are the world preparing for a future where the dollar is no longer the only game in town. For you, these are the signals that the time to prepare is now, while the process is still slow and orderly. We've journeyed through 400 years of economic history, from the ports of Amsterdam to the halls of the British Empire, and finally to the digital ledgers of the 21st century United States. The lesson is as simple as it is profound. History has a rhythm. The life cycle of great powers and their currencies follows a predictable path. The Dutch guilder, the British pound, and now the US dollar all have walked this same road. Dominance, overextension, deficit spending, money printing, and finally, Phase 5, the inflation that reveals the currency's chronic illness. As of 2025, we are living in this crucial phase. It's an era defined by not a temporary inflation spike, but by the acceptance of steady inflation as a permanent tool of government policy. The immense national debt has locked us into a slow, continuous currency debasement. The value of your savings, your pension, and your work is being quietly eroded to service the debts of the past. The warning signs of the next stage, the global loss of confidence, are here. The world is rebalancing, diversifying away from the dollar and into hard assets like gold. This isn't a reason to panic, but it is a reason to pay attention. The greatest risk in times like these is to sleepwalk through immense historical change, trusting in a system that is following a centuries-old script of decline. Understanding this blueprint is the first and most vital step to protecting yourself. Knowledge is the ultimate asset. By seeing the map clearly, you can begin to navigate the road ahead. But our journey doesn't stop here. We've identified the illness and the symptoms. The next obvious question is, what is the cure? What happens in the final, often chaotic stages of this cycle? And more importantly, what assets have historically survived and even thrived through the death of a world reserve currency? Make sure you're subscribed to continue the journey. The time to prepare is now.